Welcome, everybody, to Secret Sauce, the show where we unpack business tips, life hacks, and advice from industry leaders. I'm Karly.iacono. Today, I am joined by Jake Clopton, the president of Clopton Capital. Welcome. How are you today? Thanks for joining us.
I'm great. Thanks so much for having me on, Karly. Appreciate it.
My pleasure. So you are a very in-demand professional coming from the financing side of the business. At least from my perspective, this is at the forefront of all of our clients' minds. How do you get deals done? Where are interest rates going? And how do we navigate the insane rate climate that we're facing? So that was pretty broad. What do you want to share with us on what you're experiencing in the market and any advice for getting deals done in today's climate?
Sure, I appreciate it. Yeah, so in times like this, right, I mean, I kind of view myself as a liquidity provider to, the CRE market, right? And in times like this, when things get more difficult to get done, I mean, you're right, we do see kind of like a big uptick in demand and kind of people that are getting in touch with us. I think, navigating markets like this, and this is now my second recession going through this stuff, it really takes kind of a reevaluation of like your traditional capital sources, right? I mean, and what we see quite often is, people have been going to the same places over and over, and then all of a sudden they kind of stop doing whatever they were doing in the past, and then they have to reevaluate, go back out to the market. And what we provide is, that kind of on-demand access to, different capital sources or supplemental capital sources to what they were traditionally doing, right? So as far as like interest rates, right, and that everybody's talking about where interest rates are going, right? And I see all over the place, some people are saying, long-term interest rates are going to 12% or this or that. I think there's two parts of that curve, right? There's the short-term part, right, which is the Fed funds rates, which, primarily interacts with like short-term debt products like bridge loans and construction loans, stuff like that. And those are certainly going up and will go up in lockstep with kind of how they raise those interest rates, right? But the long end of the curve, I actually expect to kind of stay flat, basically, or even like inverted with where that is, because if you think about what they're doing, they're trying to pull back on growth, and those long-term rates are really a different type of product than short-term, and they're more tied to growth and inflation expectations and stuff like that. And so as the Fed pushes rates up, I think those will actually start to come in, and you can kind of see that happen. And every time, the 10-year treasury pops up, it falls right back down, right? The other side of that is the credit spreads, which also affect rates. And you can kind of watch what's happening in the high yield debt market to kind of get an idea of where credit spreads are going. And those are really wide right now because people are seeing a lot of risk and uncertainty in the system. I think, as we get more clarity about where the Fed's going to raise rates, those will come in. So I think over the short to medium term, you might actually see some compression in long-term rates. And I think those will stay tame kind of compared to where, like bridge loan rates and, construction loan rates are going to go.
So let's unpack this a little bit for some of our investors who are maybe a little newer to commercial real estate. When You're talking about short-term versus long-term, are we talking 5-year versus 10-year money? Can you kind of define what you mean by each of those buckets?
Yeah. So when I say short-term stuff, like I really mean stuff that's tied to like 30-day products, right? So prime, which is really tied to the Fed funds, and or SOFR, which, a lot of bridge loans and, construction loans use. So that's the really short end of the curve, right? So, and then like when I talk about longer term duration, primarily talking about 10 years. The 5s and 7s are caught somewhere in the middle there, but I think the yield curve is going to just remain extremely flat. And then, the credit spread is always that, like, when you price a loan, the swaps plus portion of it. I think that plus portion is going to start to really come in as you get more clarity about what's going on in the economy and whether or not the Fed's going to put us into recession or not.
And you mentioned an inverted yield curve on some of the longer term products. So explain what you mean by that.
Yield curve inversion is simply when the longer term rates, so like a 10-year, dip below where the short term rates are. And the spread to really watch there is the 2-year treasury and the 10. That's a traditional kind of inversion, place. So if the 10-year drops below the 2-year, that would be a yield curve invert. That's typically a sign of recession coming, right? So the 10 years, like, a point of like safety for a lot of investors. So when they start buying that up, below where, the tier rate's going to be, you see a lot of people wanting a lot of safety net out there, and that usually means a recession.
Got it. Okay. So navigating this as a private client, buying in the, let's call it $2 to $15 million space, what advice do you have for them? Because that was a lot of moving parts there that you just went through.
It is a lot of moving parts, and a lot of people come to me, and I see them trying to basically trade interest rates, right? And they're trying to pinpoint exactly when they should rate lock, and I have people come to me and say, well, I think rates are going to come back down, and then they're 50 basis points higher than when they said it, right? And I kind of tell people, like, listen, you're buying a piece of real estate, you're not trading interest rates. So I think what you have to do is evaluate everything like as it is right now, and determine whether or not to lock in for a long period of time based on what your investment strategy is for yourself, right? Not worry so much about where am I going to miss out on a lower rate in the future and this and that, right? Because, I've seen a lot of clients get themselves in trouble waiting for rates to come back down, or, trying to do that interest rate trade. And I think it's really, you got to take advantage of where it is now and understand that, hey, it might be lower in the future, or it could be a lot higher. So.
Right. So don't miss out on a quality investment, or don't miss out on an opportunity because you're trying to game the rate, basically. And
right. Day-to-day rate volatility is impossible, right, to fix. I mean, you can get an idea of where it's going a couple of months from now, but I mean, day to day, there's just so much that goes into it.
That is great advice, because I do have clients who call and say, should I wait until, 3 days from now, tomorrow? And, we don't place debt on our team. It's a very difficult conversation to have because no one knows exactly. So I think your perspective takes a bit of the pressure off to have them evaluate the deal holistically and not worry about a few basis points one way or the other in the short term.
Exactly.
Good advice. Before we wrap up, any thoughts on the market or what is working today? Anything else you'd like to share with our listeners?
Yeah, I mean, I do have, somewhat of an idea of, in an industry that I think is going to, kind of come out of this cycle, and there's going to be opportunity. I think because of what the Fed is doing, right? So the Fed's raising rates, and they're actively kind of attacking the dislocation in the labor market, right? So right now there's 2 job openings for every unemployed person. And I think the power in the hiring process at the moment is really in the hands of the laborer, right? And they can choose, kind of like, at will where they want to work and how they want to work. And I think once the Fed, is done with their job, that power is going to revert back to the employer. And because of that, I think the work from home trend is really going to get hit and probably end, right? Because employers are going to be able to command people to come back to the office. And so, the office sector right now is still so depressed from COVID, and we're going to have a pullback in the economy. It's going to be hit even further. So I think compared to the rest of the market, you've just got not only a macro trend reversal of work from home back to offices, but also back upswing in the economic cycle. So you could really see a wide outperform in that industry, asset type versus, anything else, I think, when the cycle comes back.
Office will outperform. You heard it here first, folks. I'm holding you to that, even though I don't sell office.
Cool.
Makes sense, though. It's a good perspective. Thank you for sharing.
Yeah, absolutely.
All right. That was Secret Sauce. I'm Karly Iacono. Jake, thank you so much for joining us. We really appreciate your insights, and to everyone listening, we can't wait to see you again really soon. Take care, everyone.